Hello, everybody. Welcome to this week's Fireside Chat. My name is Coburn Shepik. Happy to be with you as always. Just going to give this a couple minutes for a few people to jump on while I make sure that we're ready on our end. Okay, so this week's topic, we are going to be discussing where distress is found in commercial real estate. So last week, we had a call and talked about where or why distress happens in commercial real estate, why good real estate deals go bad. And so if you missed that, we're sort of doing a little bit of a series here around distress. There's a lot of talk in the market around potential recession. There already is to some levels. How much will it impact commercial real estate? It's unknown. We'll dive into that a little bit today at the end of our call here. But that was a fun conversation. If you missed that, I would encourage you to go back to our last Fireside Chat last week, which is what causes distress in commercial real estate. So we're going to dive right into it. A few topics that we're going to uncover today. Quick recap on distressed assets, what that actually looks like, just to cover the basics really quick. Then I want to give an introduction to Dovetail and what we're doing, and then we're going to dive into our topic today, which is where distress is found in commercial real estate. And when we say where distress is found, we are talking about if we were to zoom out and highlight the few main categories of distress, that's what we're looking at today. So from a macro level, if we were to put it in a few main categories, which we have, those are the few that we're going to be looking at today. So quick recap on distressed assets. So when most people think of distress, they're thinking of what you see on TV show, for example, a value add or a remodel, rehab properties, value add deals in the commercial space. So most distress, or what people perceive as distress, is within the asset itself. But distress is way beyond that. It's more so in the debt aspect and the equity aspect, and being potentially over leveraged and defaults and bankruptcies and foreclosures. So we're actually going to do another topic here, so I don't want to get too far into it. But basically, there is a life cycle of distress. And so for one, distress might appear in a physical sense within the asset itself, but on the part that you can't see, which is within the debt and the capital structure and between the borrower and the lender, that's where real distress occurs. And that process, which we won't get into now, has a sequence, and within each of those phases is opportunities, levels of distress, etc. So quick introduction to Dovetail. We invest in exceptional real estate assets by combining our expertise with the track record of our best-in-class partners to insulate and grow the wealth of our investor consortium. So I want to just take a few minutes and tell you guys a bit about what Dovetail is and what we're doing. So Dovetail is a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. We aligned with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. So some of the projects that we're looking at, we are focused on pretty much the entire aspect of the commercial real estate sector. What we do is we align with the best of the best operating partners in these sectors that we're focused on. For example, multifamily, build-to-rent communities or single-family rental communities, as well as industrial and some office type, hospitality type of spaces. And so we align with operators within each of these sectors, as well as the markets that we're actually focused on. Most of our projects are held from 5 to 7 years, but then again, every deal looks different. And depending on the time of the cycle and the opportunities that come up, we are doing new builds or opportunistic approaches, there's going to be a lot of distress coming up. So we're sort of holding our pens down at the moment while we wait to see where things are going. We'll get into that later, but there's going to be a lot of distress, and that's kind of what we're focused on. So who we work with established and evolved investors who are attracted to investing alongside some of the world's best operating partners and sponsors to insulate to insulate their wealth and reputation in an uncertain world. So again, we align with really spectacular operators that are focused on certain markets where they have a track record, an expertise, and have experienced economic downsides, such as 2008. That would be one of them, and we actually make sure that this track record is verified, which is super important, especially in in times like now. So let's dive into our topic today: where distress can be found in commercial real estate. Beginning here, which is number one, which is the debt. 60% of the debt, 60% of all distress in commercial real estate is found within the debt aspect of the capital stack. And so what does this look like? Just as we were talking about earlier, this looks like defaults. Okay, and it starts with being 30 days late from the borrower, and then gets more extreme as time goes on, obviously, and that process leads to foreclosure, and then potential bankruptcy, and then the lender could potentially take over or sell it at auction. We're not going to get into that all right now, but that's what happens when distress occurs on the debt side. So looking at a macro level, 60% of all the distress is within exactly what we're talking about right now: defaults, which come from being over leveraged, and lastly, which is the most extreme kind of aspect of this, is bank regulatory stress. So back in the financial crisis, and even in history, there has been distress in the banking industry, which has caused massive economic problems, and recently, in the last, just after the financial crisis, the banks are now actually being stress tested to make sure that this doesn't happen again. But in general, debt, being over leveraged, is one of the biggest areas of where distress is found in real estate. So secondly is the operator or the borrower. 25% of all distress in commercial real estate is from the operator or the borrower. Why? Because of the amount of responsibility that the operator carries. So depending on the type of deal, there might be certain key events, for example, that need to occur in order for the business plan to happen. For example, if we were doing a ground up development and the operator is responsible for all the events that need to occur during that process, which is entitlement, construction, lease up, etc. And so during that whole process, if those key events fail, then the deal ultimately fails. And so all this responsibility, key events being one of them, falls on the operator or the company that manages the day-to-day operation. And aside from the key events, again, the day-to-day operation obviously is ultimately what leads to a successful or a failed project. So what areas within the operator goes bad? There's three main areas of why this happens. You either have a weak operator, an inexperienced operator, or an absent operator, or a combination of those three. And so what we do, again, and what every investor needs to focus on, is the quality of the operator and verifying that track record, that experience, and that history of navigating potential economic downtimes. So next is the asset. And this is where, people go wrong, again, back to the beginning of our call here, most would think that the asset happens to carry the most distress, old properties, rundown neighborhoods, etc., which creates opportunity, and it does. But looking at from a macro perspective, it only carries 10% of the distress, and that looks like physical distress or simply an unattractive asset for the neighborhood, like not enough demand, for example, or back to our operator, the events maybe didn't occur, and therefore that shows up within the asset. For example, of in a residential space where the property is run down, and those events didn't occur. Therefore, the asset is still distressed. And so, obviously, in the case where there's not enough demand for the asset, that doesn't work, in which would create occupancy issues. And so, out of that perspective of the asset potentially carrying the most distress is actually obviously backwards, whereas 10% is only shown within the asset itself. Last is the equity, 5% equity, which is common equity, preferred equity. If you are buying a non-owner occupied home, for example, in the residential space, that would be common equity. And for bigger commercial deals, what we're focused on is also common equity, preferred equity, or joint venture equity. And that's only 5% of the distress occurs within that aspect of the real estate deal, looking from a macro perspective. So this occurs typically when there's debt problems, which comes from being over leveraged. And this would look like defaults on the equity side potentially. So if there's a default and the equity gets squashed, there's obviously going to be a problem there, which would create distress. On the other hand, if there is a weak operator, or if a partnership goes bad for whatever reason, the limited partners or the investors in the deal would want to get out. And so there's going to be a lot of friction there, and friction is not good. And so that could cause a distress situation where the LPs within the deal are needing to get out of the deal for whatever reason, which could cause a very unique scenario. So overall, 5% of the distress in commercial real estate lands on the equity perspective. So those are the four main areas where distress can be found. And obviously you could break into those categories even deeper, but from a macro level, those are the four areas that show distress. Debt being one of those, the big one, which comes back to the basis, which is one of the main fundamentals of or principles of buying real estate, meaning that you make your money when you buy, which is true, meaning that you get in on a good basis on the investment. And that is ultimately how you control being over leveraged. And also the operator, key events, et cetera, all those combined carry that risk. So I want to do just take a few minutes before we wrap up this call and talk about, give a quick state of the union here, state of the market. We're obviously experiencing very, very uncertain times. We have the Fed just rose rates again. Rates are rising very rapidly. We're still at a historically low level, but rates are rising very quickly. And that, combined with the extremely compressed cap rates, buyers outbidding or bidding up certain asset classes, such as multifamily in certain markets, the rapidly rising rates has created a potentially huge problem. And we're already seeing negative leverage in certain cases. It's on the headlines now, where, and we won't get into what that means now, but basically the stabilized returns of the asset are less than the less than the debt in some cases. And so that can be very, very bad and can create defaults in certain situations. And so what we're looking for, or what we're sort of keeping our eyes out for, is what happens with rates, with interest rates, because that's ultimately going to lead to what the next couple of years looks like. And so the rapidly rising rates, alongside with the amount of capital that went into certain sectors, is creating an odd pressure. And so what that'll ultimately lead to is a potentially adjustment in values, which lies within the cap rate. So our cap rate's going to follow. Yes, we're already seeing it in some cases. How extreme will that be? How correlated will those follow? Obviously, there's still hot demand for a lot of certain assets, and a big investor party have been very optimistic, maybe overly optimistic in some cases. We're looking at deals where it's just like, how is that even? How are they paying that? And so we will see what happens. And I think that there's going to be a lot of amazing opportunities coming up. I think there will be a lot of distress because of some of the values that things have been trading for are insane. And so rents can only go up so much, and it'll create a lot of pressure on the home buyer side as well as the renter side. And it can't be supported that much longer. So we'll see what happens. So we've got our pens down right now. We're holding on to our powder for the upcoming opportunities, which I believe there will be major once in a generation opportunity for potential distressed commercial real estate. And so we're holding on to those to our powder to take on those opportunities. And so what does that look like? What are those opportunities going to look like? This is why we're having these conversations, to come up with, to uncover and sort of remind ourselves what happens, what it looks like, and how can we be there to help clean up some of those messes. And it is going to happen. To what level and to what extreme, completely unknown. But there will be unique opportunities. There will be a lot of special situations, a lot of distress, and we are planning for that. So thank you for being on this call. I had an amazing time. If you are interested in learning more about our upcoming opportunities, can't speak. I invite you to join our waitlist. You can go to our website, dovetailig.com/waitlist, or just dovetailig.com. You can click on the button right there on our home screen. If you'd like to speak with us, I'd love to set up a conversation with myself or someone on our team to share with you a bit more about what we're doing, what we're looking at, and how we might potentially align together. So if you go to our website, you can schedule a call there, or send us an email, partners@dovetailig.com. If you're on this call, there's a link here. If not, I'll put one below here. Also, we are running a survey, and I love to invite you to participate. We're going to be working on a project later this year that we'll be releasing some highlights that I think could be fascinating with. So if you are obviously interested in commercial real estate, if you're on this call, we hope you are. So you can find that survey. I don't have the link here in front of me, but it is dovetailig.com/survey. So if we'd love to have you participate in that. It should only take a few minutes. So thank you again. My name is Coburn Shepik, wishing you an amazing day. We will be announcing next week's Fireside Chat, which will be aligned with our conversation today. We haven't totally solidified the subject, but but it will be in the distressed category, and we're excited to continue this discussion. So wishing you an amazing day. Talk to you later. Thanks. Bye.